Hey guys, Sean here. CPI inflation numbers are out and it's a horrific 8.6% for May. Now, this is an insane 40-year high, and guess what? It could get even worse. Now, at this point, the whole world should finally see through the rules, the smoke and mirrors that the Fed has been selling to us, and really understand that inflation is out of control. Now, we are seeing the markets get decimated, stocks are imploding, and bondholders are just getting slapped in the face. But if you bought gold, you are the big winner in this week's freak show where everything else is crashing to hell. Now, the problem with skyrocketing inflation is how it has the potential to take down the entire economy because it changes the behavior of how we spend our money. Just think about it, your money is worth even less today, housing is going up, and the remainder left is just enough for food and fuel. Now, magnify this situation across millions of people, not just in America but the entire world as well, and you can immediately see how this has the potential to take down the entire economy. And in this video, I want to dive into the deadly consequences of high inflation, how it could trigger a domino effect that will just set everything on fire from stocks to bonds, and why commodities might be the last one standing once the smoke clears. Now, if we peel back the CPI inflation numbers for May, we can see the truth about why we just hit an all-time high again. Now, energy is leading inflation at a whopping 34.6%, while gasoline is almost hitting 50%. Now, that is crazy, and we can expect to see prices at the pump just jump once again. But I want us to focus more on fuel oil, which jumped an insane 107%. Now, fuel oil is used in powering those large container ships that transport goods and commodities around the world. And if fuel costs have doubled, this will have a ripple effect on the prices of almost everything, right? And we're talking about way up. Prices of fruits and vegetables will soar and bread will become more expensive because the global supply chain has now gotten much more expensive as well. I recently made a video about how oil could rise above $150 easily due to the Russia-Ukraine war and how unprepared the West was to combat the blowback from the sanctions, and now we are suffering from the horrible consequences. And when it comes to food inflation, the number is just as frightening, clocking in at around 10.1%, and that's double digits for food, and it's going to be harder and harder to put food on the table. And that's why I believe the true inflation number for the majority of us is a combination of food and fuel, and not just the heavily massaged figures of the overall CPI. Now, realistically, it is anywhere between 10 to 20% in the real world. Remember all the BS mainstream media and experts were calling for peak inflation? Well, it seems that Peter Schiff was right again, and inflation is far from peaking. Now, how bad can it get? If we look back in history, we can see that inflation cracked above 10 to 15% back in the 80s, and I won't be shocked if that happens again. Remember that inflation is a consequence of money printing and supply crunches around the world, so the full effects might still be down the road. Now, the big problem with high inflation numbers is that it will cause the Fed to overcorrect. There has been nothing calculated and measured about the Fed's approach to monetary policy. Their response to the '08 crisis and the 2020 crash was to print up trillions of dollars and lower rates to near zero. And this time, to really combat runaway inflation, Powell and his merry men might just dial up the rate hikes and tighten even faster. The next rate hike could be 100 basis points for all we know, and the market is predicting 4 consecutive rate hikes of 50 basis points apiece in a row to really bring interest rates to near 3%. Remember that the midterms are coming up in November 2022, and Biden is probably breathing down Powell's neck, so it isn't too far-fetched that we can see rates spike up month after month. And if that happens, if the Fed decides to do the right thing and control inflation, this could really trigger a chain reaction that we need to be aware of. Now, we are talking about bonds collapsing and the stock market getting burned to the ground, and it all starts with the debt market. Now, if you hold tons of fixed income or you're in bond ETFs, you might be entering a world of pain down the road. Firstly, let's talk about bonds. The bond market is collapsing. We can already see the 10-year yield at 3.17%, spiking up towards a 5-year high. Now, this is catastrophic for bondholders, as now bond prices are getting clobbered, and we are going to see lots of pension and fixed income funds just lose trillions. And that's the thing about inflation that keeps soaring. There's truly nowhere to run. Sure, you can buy bonds or bond ETF today, but if inflation keeps going up and up and the Fed is forced to raise rates, your interest payments can't keep pace with inflation and bond prices will drop as well. Now, if this happens and bondholders suddenly wake up from their drunken stupor, we could really see a flight of money out of bonds. People will be dumping bonds like it's going out of style and trigger an enormous exodus of capital that I think will just freak everyone out. So where will this money move to? After all, if you stay in cash, you are automatically losing 8.6% a year, no questions asked. Will the money move into equities? Well, it might, but we need to examine closely what rising inflation will mean for the stock market. And we're going to talk generally here, right? Because there'll always be some stocks here and there that will just defy gravity, but we are saying the stock market as a whole. If we take a look at the S&P 500, we can see an absolute bloodbath here with the index almost crashing below 3,900. Remember, the technical definition of a bear market is 20% from the recent high, and now we are flirting around 19%. And this is the problem with the stock market. There's very little to no price discovery today, and if this route turns into an epic crash, we do not know how low the S&P can go, because the last two times the market crashed in 08 and 2020, the Fed, or what I like to call the plunge protection team, came in, lowered rates and injected liquidity back into the system and just propped up this zombified economy up. So it's anyone's guess if the S&P could fall to 3,500 or even smash below 3,000. Now the issue is with the stock market is it is controlled by a huge extent by the debt market, and it all has to do with higher bond yields. The higher inflation goes, the less attractive bonds become, and lenders just exit the market like what we are seeing right now. Bond prices plunge, bond yields increase, and that means money is flowing out of the debt market. So what does this mean for company as a whole? Now they can no longer borrow at dirt cheap rates like in the past. Remember that the rate that companies borrow is always higher than treasuries, because a company can technically go bankrupt, but the US government can simply inflate its way out of debt if needed. So the market is starting to price in this pain, and if rates really go up by another 1 to 2%, it is highly possible that the cost of borrowing or the interest payments that companies have to make could just double just like that. And that's why we are seeing companies starting to slow their expansion plans. We are seeing hiring freezes across the board. Even Elon Musk is considering laying off 10% of Tesla's workforce thanks to a super bad feeling. So where does this leave us? If money is flowing out of the bond market and money is leaving the stock market and cash is evaporating at 8.6% a year, where will capital flow to? And this is where I believe the move towards commodities could happen, and we might be on the brink of a commodity super cycle. The interesting thing about commodities is that they are the building blocks of life and they have intrinsic worth. And we are seeing a breakdown of speculative money and people starting to run from the intangible to the tangible, from risk-taking to safe haven assets. And I'm beginning to already see this from some of my own paper positions in the market. Gold and silver are up, gold miners are up, and commodities as a whole are up. Now, Jeff Curry from Goldman Sachs has long been talking about commodity super cycle happening, and there's a good chance that this market crash could really spark the big rush into commodities. Now, investors could suddenly realize that bond yields are no longer worth chasing when inflation is eating up your purchasing power at over 8% a year. Remember that companies are also going to find it increasingly more expensive to grow in the coming years if the Fed keeps rates up. Now, this is where the average consumer behavior comes into play as well. It would really seem counterintuitive that if the prices of basic consumer goods and essential staples are rising, won't asset prices across the board also continue to go up? And that is a big fallacy or trap that we need to step away from, and it's really simple. If food and gas prices keep going up and your basic necessities are unmet for a prolonged period of time, you will be willing to sacrifice everything else in your life to eat and stay alive. It is the same idea of which is more valuable if you're trapped in the Sahara Desert, a bottle of water or a bag full of diamonds. It is the same logic, right? We'll all go for the bottle of water every single time. And that is why as inflation keeps soaring, people are being tilted more and more towards only purchasing the essentials of life that have intrinsic value. Now, I'm talking about food, water, and fuel. Now, gold and silver, they play a really special role here because yes, you can't eat them, but they have been monetary metals for thousands of years and they have the weight of history under them. And whenever there is a need to exchange or to store value long term without any risk of debasements, such as fiat currency, precious metals also benefit from the commodity super cycle. And it's really super obvious when we see the price of gold over the last 20 years. Every time the Fed starts printing money like drunken sailors, gold just spikes up in price. And it's not really because it is appreciating in value, it is just an inanimate object. It's because the dollar is becoming more and more worthless. So how do we position ourselves for this market crash? And the easiest way is to get into commodities early before the majority of people suddenly wake up and start piling into the market. Now, there's a lot of money in risk assets such as Bitcoin and the stock market, and even money in bonds is starting to look like risky plays as bond prices are currently plummeting to earth. Now, the way I'm playing this is by simply buying gold and silver. I stack physical gold and silver first because I believe the physical premiums will continue to rise as inflation soars and demand for the physical metal just piles in. Next, I am also accumulating shares in PHYS and PSLV. Now, these are gold and silver trusts that actually hold the allocated precious metals, so there isn't much worry about not having the physical metal if investors want to redeem their shares and take physical delivery. I'm buying both physical metal and shares in the trust every single month. You can just access it through your stockbroker to really bet against the debt bubble and get a front row seat when the commodity super cycle takes off. Now, another way you can get direct exposure to commodities is through the ETF PDBC, which I also personally buy. Now, the fund holds a broad mixture of commodities across the board, including crude oil, base metals, precious metals, and agriculture products like corn, wheat, and sugar. So if you just want a whole laundry list of commodities, if you're a bit lazy like me, PDBC is quite a good option that you can also consider as well. Now, if you're a cowboy and you want greater returns, then you can speculate with the gold and silver miners. When the price of gold and silver rises, they will experience better gains. But you also got to remember that these are actual companies with employees, and as inflation soars, so does their salaries, their operating expenses, and the cost of borrowing. So if a company screws up, you could really see the price of gold going up, but their stock price plunging down. So I do hold some speculative positions in the GDX and the GDXJ ETFs, and they give me exposure to both the major and junior miners as a whole because I personally find it crazy to try to cherry pick individual companies in this sector. Right now, it's still very dangerous to say if inflation has peaked because the prices of oil could still continue to go up and the conflict in Ukraine could definitely escalate as well. So the best we can do is to really watch carefully how this plays out and be smart with our money. Food prices are likely going to go up in the near future, and I won't be surprised if prices at the gas pump goes up by yet another 5 to 10%. Now, you definitely want to have a strong cash position as the markets continue to implode and not lump sum invest into anything, whether that is commodities or stocks in general. If you can stockpile food, I think that is the one winning move you can make for a guaranteed return on your money. Everything else could continue to move lower, even gold and silver as well. They could get smashed into the ground if fear really morphs into full-blown panic. Now, the amount of volatility we are going to see in this market is going to be epic, and I believe there will be multiple bull traps, huge spikes up and down that we have never seen before. But if you have the purchasing power, there will be great deals that you can pick up, and if inflation continues to stay high and rates continue to go up, I personally want to be positioned in commodities. So do your own research on this and investigate more into the ground situation that we are facing. Remember that if the Fed suddenly comes in to print money, then everything changes and we can suddenly see bonds and stocks rally. But at this point of time, I find it rather unlikely. They are now on a mission to salvage what's left of their broken reputation. So let me know what you think in the comments below. God bless you, stay safe, and if you enjoyed today's video, be sure to smash that like button and subscribe for more videos as we navigate through this economic insanity. So thank you guys for watching, and I'll see you soon.